If the market drops 40% the year after you quit, the question is not only how much money you lose, the question is what part of the retirement plan breaks first. Is it the portfolio, the spending plan, the cash buffer, the tax plan, or the confidence to stay retired? That is why sequence risk matters so much for someone retiring at 40. The average return is not the whole story. The order matters. Imagine two households retire at 40 with the same portfolio and the same spending. Over the next 20 years, they get the same average return. But one household gets the good years first. The other gets the bad years first. On a spreadsheet, the average might look similar. In real life, the experience is completely different. The household with early good years gets breathing room. The household with early bad years is withdrawing from a wounded portfolio while trying to learn how to live without salary. That is sequence risk in plain English. When you are working, a market crash can still hurt, but the paycheck changes the feeling. Salary keeps groceries paid. Bonuses may still arrive. New contributions can buy at lower prices. The portfolio is wounded, but it is not the only source of life. After you quit, the same market drop hits differently. Now the portfolio is also the paycheck. Selling during a downturn may be necessary to pay real bills, and that can make the damage feel more permanent. This is not just math, it is behavior. Start by diagnosing the weak point. If fixed spending is too high, the spending plan may break first. If there is no easy cash or low-risk reserve, the cash buffer may break first. If all withdrawals come from one account type, the tax plan may break first. If the household cannot tolerate seeing the balance fall, confidence may break first. The portfolio number matters, but it is not the only part of the system. A retirement plan is a set of connected parts, and a crash tests the weakest connection. A cash buffer can help, but it is not a magic shield. Too little buffer can force awkward sales. Too much buffer can create its own long-term drag or false comfort. The right answer depends on spending, portfolio design, taxes, risk tolerance, and how much flexibility the household has. We are not trying to find a magic buffer number here. The point is to know what the buffer is supposed to do. Is it paying must-have spending, buying time, protecting emotions, creating room to avoid selling certain assets at bad moments? If the job is clear, the buffer becomes part of the plan instead of a superstition. The real defense is flexibility. Some spending can be delayed, some travel can move, some Roth conversions can be adjusted. Some income can come from part-time work, consulting, or a small project. Some assets can be used in a different order. Flexibility does not mean the plan is weak. It means the plan knows markets are not polite. A rigid plan has to be right. A flexible plan has options when the first years are ugly. That is especially important at 40, because the plan has many years ahead of it. A simple stress test is to pretend the first 2 years are bad. The first question is not whether the average return over 30 years is fine. Ask what you would do next month, next year, and year 3. Which bills are fixed? Which spending can flex? Which assets would you sell first? Which account would you avoid touching if possible? What would make you go back to work, even part-time? This exercise is not about predicting the crash. It is about rehearsing the response before emotions are in charge. Compare two households with the same starting balance and the same long-run average return. The first gets good years early. The second gets a sharp drop in year 1. By the end, the averages may look similar, but the lived experience does not. The bad first household has to withdraw while confidence is lowest. That is the emotional center of the problem. Instead of stopping at, what if the market drops? The next question is, what still breaks after the obvious adjustments? Maybe the spending plan already has some flexibility. Maybe the cash buffer has a clear job. Maybe the tax plan is not perfect, but it is no longer random. Now look for the next pressure point. Healthcare may still need its own margin. A concentrated position may still be carrying too much weight. The household may still need a rule for what happens if confidence drops faster than the portfolio. Once the first weak point is named, the household can work on the thing that actually carries the pressure. A 40-year-old retiree has time, but time cuts both ways. Long-time horizons allow recovery. They also mean early mistakes have many years to echo. That is why the plan needs levers before the bad year arrives. Maybe the lever is a cash reserve. Maybe it is lower flexible spending. Maybe it is part-time income. Maybe it is a slower withdrawal rate. Maybe it is a rule about which assets get sold first. Maybe it is a plan to delay a large purchase. The exact lever depends on the household. The important part is that the lever exists before the market tests the plan. If one more year is on the table, ask whether it improves the crash plan. Does it build a bigger buffer? Does it lower fixed expenses? Does it diversify concentrated stock? Does it create a clear spending flex rule? Or does it mostly add another year of market exposure while the first break question remains unanswered? That is the material change test for sequence risk. More money helps, but a better response plan may help the household trust the money it already has. Before the paycheck stops, the household should be able to say, if markets fall early, we first adjust this. We avoid selling this if possible. We use this buffer for this long, and if the stress lasts longer, these are the next levers. That sentence will not prevent a bad market, but it can prevent every bad market from becoming a brand new decision made under pressure. That is the point of a sequence risk plan. Sequence risk sounds abstract until it is attached to a household. Then it becomes concrete. What happens if the first 2 years are bad? What changes if the portfolio is down and healthcare still needs to be paid? What if the household needs to draw money while the market is ugly? Those are not fun questions, but they are the questions that make the plan sturdier. A strong FIRE plan does not pretend bad markets vanish. It decides ahead of time how the household will respond. Sequence risk is not just a textbook term. For an early retiree, it is the possibility that bad years arrive before the no-paycheck plan has built confidence. The answer is not to predict the market. The answer is to know what breaks first and build flexibility around that weak point. Same average? Different order? Different retirement experience. If you want FIRE plans that can handle bad timing instead of only perfect spreadsheets, please subscribe to the channel. I will keep stress testing the fragile parts.